the reason the stock market went up, dollar for dollar, was actually tied to the growth in the M2 money supply. The correlation was 0.92. So for every dollar that the Fed printed, the stock market went up by 92 cents. So, it stands to reason that if the Fed is going to take $3 to $5 trillion of value out, then we have to re-rate the equity markets by $3 to $5 trillion at a minimum. And then you have to re-rate and re-baseline for earnings. And so that's probably another 20 or 30%. And all of a sudden, demand is stable, but it's not necessarily stable. And in a demand contraction, yes, people get fired, but then also new job openings change, right?
Yes.
There's fewer of them. They're more specific in the way that people
salaries go down, right?
The thing that you have to do before you talk about what is happening now, I think it's probably useful to go back, and you have to really start at the end of the great financial crisis. And the reason is there was a bunch of people coming out of the GFC who confused what the US government and some European governments were doing. At the time, there was the risk of a huge financial contagion. And so the US stepped in, and the Federal Reserve started to use their balance sheet to buy toxic assets, right? And the ECB did that, and I think Japan did that as well. Anyways, a bunch of banks did it. A bunch of governments did it. And then there was this body of pseudoscientific economists who coined this thing called modern monetary theory, which basically said, hey, you can keep printing money and introducing it into the economy to smooth things out and to actually drive long-term growth. And it turns out that a bunch of government officials fell for it. And if you fast forward to 2022, so 14 years later, governments around the world had printed something to the tune of about 35 odd trillion dollars of money into the economy that should have never been there. So the thing to remember is we have not necessarily just been obfuscating true supply demand in the last 6 or 8 months when we've been talking about a recession or inflation. We've been actually doing it since 2008. It's just that it's been building up in the system. So one of the things that we have to realize is that all of that money somehow needs to get destroyed in some way, shape, or form if the true economic equilibrium is meant to be found. What is true supply? What is true demand in the absence of government sloshing money around, trying to prop up things that should not be propped up, or buying votes, or all the grifts that these folks have engaged in the last decade and a half have to get undone. So that's the backdrop. So if you think about taking $30 trillion out of the global economy, you're talking about almost, I think it's 85 trillion is the world GDP. So it's almost half of an entire year's worth of global GDP. It's going to take 3 years probably of the slow, meticulous, running off of money, not reintroducing new money. So it seems like we're at the beginning of something that's going to be long and drawn out. Now that's separate from whether we're in a recession or not. That's just the bear market that we're in, right? And so you have to look at asset prices today as a microcosm of a much larger trend that has to be about fake money pushing asset prices up, and now taking all that fake money out and finding out what the real price of something is. And I just don't think that takes 6 months. So for all the people that were, fingers crossed, hoping that this would be the end of it, Fed raises 75, we're done with this, they're going to raise 75 more. I just think that's not how it's probably going to be. It's going to take, 24, 36 months. That may mean the bottom doesn't happen for another 18 months. So I think we're in for a lot of choppy market action. I also want to tell you guys a quick story. One of the most interesting canaries in the coal mine of all of this was 2 days ago and what happened to Facebook. And this sort of ties a lot of this stuff together in terms of economics, inflation, asset prices, equities, tech. Then we can try to talk about non sort of, big tech. But everybody was saying, oh gosh, the market's going to rip on the open. We were closed for Juneteenth. And then on Tuesday, the market, the S&P was up 250 basis points, 2.5%. And the NASDAQ was also up, call it maybe 300 basis points, roughly. But Facebook was down 400 points, right? So it's a big spread. And why is that? And I was like, this makes no sense to me. What is going on with this price action? Everything was up. Apple was up. Google was up. And so I called around and, I was like, why is this happening? And this is the best explanation I got. When you look at who the incremental buyer is in the stock market, it tends to give you a sense of whether prices can go up or will continue to go down. And the poorest informed buyer tends to be retail. And the most informed buyer tends to be these very large institutional hedge funds, right? So there's a spectrum. And Facebook is an example of of big tech that is poorly owned by retail. So it's mostly owned by smart money. And the case that smart money makes for owning Facebook is that it's got an extremely cheap price to earnings ratio. So you must own it. And what they said was that they, looking at the tea leaves of consumer demand, what they actually re-underwrote was that actually, it's not that the price to earnings was cheap, it's that the E in PE was just wrong. And if they pass through all of these increases in inflation and, their earnings expectations into Facebook, it's actually more like fair value at a lower price. That's why they sold it so much on a day where the market was up. Now, why is that important? Well, eventually you're going to touch all these other stocks as well that are going to go through earnings revisions in this recession. This is where I think Wall Street has done a very poor job on behalf of retail. If you look at the average estimates of earnings, you will be shocked to hear that Wall Street actually has this year being record earnings, next year earnings continuing to go up. How is that even possible?
Well,
how is that? If you're sitting here, how do you see earnings continuing to go up into these prints like this when you cannot pass through 80, 90% increases in energy and COGS and whatnot? Is that what you think the consensus view on Wall Street is? That basically a bunch of people get fired and so that's why earnings continue to go up? I'll give you the counterfactual. I think Wall Street's wrong.
Okay.
And I think that earnings are going to go down this year and will definitely go down in 23. And so I think what probably happens is the entire world of equities needs to get repriced at a lower price. And in that, it's going to put enormous pressure on these cash-burning, non-profitable tech companies. Countries like Europe are still doing it. 9% inflation in Europe, and they're still buying bonds. The thing that you have to do before you talk about what is happening now, I think it's probably useful to go back, and you have to really start at the end of the great financial crisis. And the reason is there was a bunch of people coming out of the GFC who confused what the US government and some European governments were doing. At the time, there was the risk of a huge financial contagion. And so the US stepped in and the Federal Reserve started to use their balance sheet.
Going back to the broad general VC community, there isn't a lot of either intellectual courage, in my opinion, but also there isn't a lot of moral courage. There's really not a lot of people that stand up for something and really want to draw a line in the sand on something that's structurally important and say, we're going to solve this. And it's because we've replaced practitioners who do it as a way to pay it forward with people who are doing it as a job. And people who do things as jobs, and as entrepreneurs you'll relate, are never going to do it the same way as an entrepreneur will do it. Because the entrepreneur lives and dies by those decisions every day, and they really feel validated in being in the grind. And someone who's doing a job is not trying to get fired. They're fearful. I think that we are in a really bad place that will only get solved if we create some fundamental innovations. Like, we're in this very difficult predicament that can only be solved with true fundamental innovations and leaps forward.